tough to follow, man. I gotta start practicing my stand-up. I'm gonna be following these guys. But thanks for making the time. Can everyone hear me? My voice is a little rattled, and I hate these things. Closer? All right. So I just want to sort of level set a little bit so I understand what you guys want to hear, because the last thing I want to do is just sort of drone on. So Q&A is absolutely welcome if you want to make that portion longer. That's always good. I want to make sure you're getting your questions answered and we're walking through something that's relevant to you. So with that in mind, Michael kind of did this before, but how many people here are actually looking to raise money, period? All right, so definitely the majority. And how about from venture capital? You're pretty sure that that's the right way to go versus some other alternate source of financing? Okay, very cool. All right, well, look, I'll jump in, and if it's too high level, let me know. We can go deeper. If it's too low level, let me know. I can sort of raise it up a little bit. So as he introduced me, John Waller, partner at Okapi Venture Capital. My background, I actually grew up right here in Pasadena and moved to New York. Started my first company in 1993, 94, right as the internet was becoming commercialized. That company ended up doing okay, and I used the money I made from that to jump back into the startup world, either as a serial entrepreneur or an angel investor, consultant, anywhere in between, and all of the above. Moved back to LA in 2003 and joined Idealab. Probably most of you are familiar with Idealab, where I was running their new venture group for a couple of years, and then one of their companies for a couple of years, and then I went and had a 2-year stint at Mattel, of all places, to help with their strategy and understanding the disruption that was going on with the traditional toy company. It was interesting times for sure. After a 2-year stint at Mattel, I joined an old friend at Okapi Capital, which is an early stage tech VC fund, where we focus on pretty broadly all things tech. We are almost exclusively looking for opportunities in the Southern California area. We like SaaS businesses, we like IoT businesses, connected devices, and sort of anything that is a true disruption or has the potential to be a very real disruption in an industry or marketplace. We write checks anywhere from $250,000 on the low end to $750,000 on the high end, first checks, and then we reserve another 2 to 3 times that for follow-on as the company scales and grows. So that's a little bit about me. If you guys want to know about VCs, and by the way, if we want to talk about angel investing or other sources of financing, that would be wonderful too, but the topic is VCs. So the most important thing, I think, to understand about VCs is some of the core metrics of how these VCs operate, what's important to them, what's not. And the reality is that VC business is a hit-driven business. The majority of these companies that we're going to invest in, unfortunately, are not going to pan out in a meaningful way. And that's just the way it works. Unfortunately, you're investing in early stage stuff. It's risky. Some of it's not going to pan out. Most of it's not going to pan out. So you need to ensure that the ones that do win, the ones that do hit and are successful, are monsters and have a chance to basically return your whole fund. So if you got a $100 million fund and you invest $2 million in one company, you need to be able to pencil out that one opportunity can return the entire fund. So that's got to be a $100 million exit potentially. So the rule of thumb is a 10x return. If a VC doesn't feel like they can't potentially get at least a 10x return on their money, is probably going to make a pass. So that, in reality, sort of excludes a lot of really great opportunities. There's plenty of wonderful businesses that can make the entrepreneur and founder and the company and the employees and shareholders a lot of money, but not in that way. And there are lower risk opportunities that just there may be wonderful businesses that VCs just can't touch just because of the metrics. It's the way it works out. The other thing is each VC is unique. Even though there's, the sort of VC uniform, khakis and blue shirts, and I've kind of got half of that on. But what they focus on is unique, the stage is unique, the check sizes they do, the geography they focus on, the industries, everything is very, very unique, even within the same firm. So it's important to do your research on the particular VC. If they're, a good fit for what you're pitching, it'll save you and the VC a lot of time, and you're going to end up having to knock on a lot of doors, even if you're reaching your target market. So it's worth it to do your homework and really focus on make sure you're pitching to the right type of VC who's interested in the type of thing that you're working on. Make sense? Thoughts, questions? Wonderful. Okay, so VCs are in the risk-taking business, supposedly. Some of you who have sort of been through this dance before probably have gone through some frustrations where the things that VCs are looking for are such that you feel like, you know what, if I had all these things, I wouldn't need you, thanks. I've already got it because I've already got the revenue, and I get it, and I've been in those shoes a lot, and it is frustrating, but the reality is there's a lot of different opportunities there that VCs can look at, and so the bar is much higher now than it ever has been in the past. And so what we look for is proof points, validation, risk mitigation. Yes, we're in the risk-taking business, but we still need to optimize where we're putting our capital, and so we're going to dig deep on the data points that we can have access to and be draconian about sticking to those metrics that we're going to be demanding of. Like I said, so it's hard for any early company because there isn't a lot of data points, right? The company's only a year old, whatever, that probably doesn't have a big customer set. It's not like Warren Buffett that sort of researches companies that have been around for 100 years and can reliably predict what's going to happen. You've got a very limited data set in a very uncharted, usually market with an unknown technology. So you really need to hone in on what you can identify and lean in as a founder to whatever those proof points are, whatever those strengths are. Each company has different strengths. Maybe the founding team is wonderful. Maybe another company has patents. Maybe another company has some early traction with customers, but not so much robust technology. It doesn't matter. There's a lot of different things that can be meaningful to an investor, but just lean into whatever those strengths and proof points are, because that's the only place you can hang your hat on with these early stage companies that don't have a lot of historical information. Stories, because you're painting the future, you're talking about a big vision. VCs, human beings in nature in general, like stories. You need to paint the picture for them. These VCs, we write checks. We aren't necessarily the most imaginative one out there, so we like to lean back and be taken in by your story, by that compelling vision that you are going to paint and you're going to create with your hard work, blood, sweat, and tears. As well, this is a little bit more inside baseball, but if you really have something compelling and you feel like there's not some traction, there's always some... Yeah, question?
Yeah. This is generic. Can you tell me from your experience, the company that how you went through this step, something maybe out of the ordinary, something, what pointers did you look at when you're trying to a specific example?
Specific example that
Can you repeat the question, please?
I think he was asking for, this is all nice general stuff, but how about some specifics about what I have sort of looked at? Is that the question?
Yes.
Yeah, well, we'll get into that. We'll talk about that. But generally, what you're looking for is at least, maybe more than one, but the one thing, right? Sometimes it's a patent or set of patents that has a very, very clear market opportunity, very, very strong protection. You know that there's competitors that are probably utilizing this patent, and you feel comfortable that, you know what, this is my competitive edge, this is my moat, and I'm going to go do this. Sometimes it's a founder. It's just an incredible, one-of-a-kind, I mean, you know, the archetype you think is a Steve Jobs or Elon Musk. Smoking weed, probably not the best thing. But that aside, you know, that can be something too. In fact, I do have an investment of one of those types of founders, I believe. Didn't have a lot, very young, funded him when he was 19 years old. There's Andy Wilson back there who made the introduction. Thank you, Andy, I hope. And you know, it's just a phenomenal founder, understands his space better than someone 3 times his age, understands an opportunity set in the market better than, you know, anyone, certainly his age, like I said, probably 2 or 3 times. So sometimes it's the founder. Sometimes it's the early traction they've already gotten, right? Someone's only raised 50 grand, but they're already doing an annual run rate of, you know, 300. It's like, you know what, this guy didn't seem all that impressive, but look what he or she has accomplished in 6 months, a year, with very, very little money, little traction. Sometimes it's a crazy technical founder that can do cold fusion. So, like I said, getting back to this, it's just those, whatever your lead is, whatever you think is your best foot forward, that's what you lean with. And it can be different for any type of opportunity and any entrepreneur. Is that? Okay. So, Perfect VC Target Company, that's the name of the speech. Well, the good news is it's easy. I can basically lay it out in one slide. Here's a slide. So, in all seriousness, it doesn't exist. The perfect VC company, a backable company, does not exist. And some of it can't, by definition, exist because they are in conflict with each other. So one of the things, you know, an example will be a market that is huge and growing quickly. Multi-billion-dollar industry and a market that is growing very, very rapidly. The other element of a great fundable company is very little competition. Well, that doesn't happen, right? You don't get multi-billion-dollar industries that are growing rapidly with no competition. So just appreciate that. But I still think there's real value in walking through some sort of a framework and structure and understanding, okay, these are sort of some of the things, or a lot of the things, that investors are going to look at. VCs, angels, anybody is going to be evaluating these opportunities on some of these metrics. Make sense?
Yeah.
All right. So breaking it down a little bit, founders, like I said, most important. Everything starts with the founder. The earlier the stage company it is, the more true this is, for a few reasons. One is, you may have heard this sort of phrase, you know, do you bet on the horse or the jockey? Do you bet on the opportunity, the business plan, the market, or do you bet on that entrepreneur that's riding that opportunity? Well, in early stage venture, and sometimes even later, you always bet on the jockey, because everything stems from that jockey. The analogy kind of breaks down a little bit because the jockey isn't creating that horse, but you know what I'm saying. The jockeys don't ride shitty horses. So if you don't understand the market, but you buy off on the entrepreneur, it's oftentimes a bet worth taking, because you can have confidence that that entrepreneur, if he or she is good, is not going to go into a lousy market, is not going to create lousy technology. So founder. That's the good news, right? You guys are all, a lot of you are founders. You guys are better than everyone else in the room. I'm not sure how that's possible, but you guys should believe that. So that, I can't stress that enough. Co-founders are always good to have, especially if it's a technical co-founder or you are a technical founder. In my business, where we invest in technical companies, you need to have somebody who has those tech chops. If you're a non-technical founder, try to find a technical founder, because you're going to stub your toe a lot less, you're going to waste a lot less money, if you've got a good technical person that can help you build this. And if you are a technical person, wonderful. Vision, no small ball, like I said. Venture capitalists, at least, don't have an interest in buying or investing in a company that's going to top out at selling for 10, 20, 30 million, right? That's just not, the arithmetic doesn't pan out. So you want to back a founder with vision, that's excited, obviously smart, they're committed, they're going to die trying. You really need to believe that. There was a few years ago, I don't know whether it's still around, this sort of mantra of fail fast, right? Well, I think that's kind of true in that you want to iterate fast. You want to do a bunch of trials on your product, vision, opportunity and see what works and what doesn't. But no one wants to write a check with someone who's not sort of fully committed. You guys heard the pig and the chicken for breakfast? You guys have all heard that? No?
Take us through it.
Well, just the saying is, you're having breakfast, the chicken is interested, but the pig is committed, right? The chicken's laying an egg and moving on, the pig is giving you the bacon, right? So they're all in, they're committed, and there's a huge difference in that, right? And doing this stuff, being an entrepreneur, having a successful company is not easy. And it's going to be hard. Even these overnight successes, they take 10 years and they're considered overnight successes. And there's dark times. Always. I've yet to hear of something that just works out wonderfully. And so you need to feel like that company, that founder, that executive team is willing to go through those really difficult parts. Especially in the early days, you're not getting paid what you're worth. You're working, a lot of hours. Everybody thinks you're crazy. And, so you got to feel like that person's got some real iron. Domain expertise, that's obvious. I don't want somebody looking to go into the beauty business that's been a welder for their whole career. You need to have some relevant experience. Serial entrepreneurs are really great. Somebody who's been through it before, who can see around the corners. That's not always necessary. There's certainly recent grads that do phenomenally well, but serial entrepreneurs are a good thing. Cheap, they don't like to spend money. They're going to need to be spending money, sometimes a lot of money, but you always are looking for somebody who can do a lot with a little. And raising money is not the be-all, end-all. That's not success at all. It's all about are you going to use that money in a very efficient way, in a disciplined way, because hopefully that's obvious. Confident, like I said, if you don't believe it, why should we? If you don't have the confidence and you go in there timidly, it's unlikely that someone's going to believe in that vision if you're not, 1,000% committed. Same time, you got to be humble. No one wants to feel like this guy's or girl's just a blowhard and telling you a bunch of stuff that you want to hear and is not sort of got their feet on the ground about what it's really going to take and what they don't know, because nobody knows everything, especially when you're trying something new. So that's a sort of an interesting balance where you want someone confident enough on where they want to go, but humble enough to appreciate that they might get some benefit out of some coaching, or they might not have all the answers. Some people phrase it as long on vision, committed to vision, flexible on the details, flexible on the tactics. And then I guess to sum it all up, will the VC invest in the person, regardless of the opportunity? Because that's what they're really doing at these early stages, right? They're investing in you, the entrepreneur, because there isn't a whole lot else to hang the hat on. Perfect VC target company, low valuation. We like to invest in companies that have lower valuations, clean cap table. If you know where cap tables are, sort of really just the corporate structure. How many shareholders are there? Different classes of stock. What's the debt look like?
Can you give a little more specifics on low valuation? Because the numbers are crazy right now.
Yeah, they are crazy right now. Look, this is, to a certain degree, there's a little bit of a signaling issue, right? Because if the entrepreneur is that good, yet he's willing to sell his company for dirt cheap, on the one hand, that's good in the short term, but you're wondering, boy, this person may not be the best negotiator, may not be the best, person you don't want that person sort of running your business if she's giving away the store. But generally speaking, entrepreneurs are going to overvalue their companies, and VCs are going to maybe undervalue their. It's all about perspective. There are rules of thumb about what a SaaS business is going to do. What's the going multiple these days for SaaS types businesses with a certain growth rate and a certain MRR and things like that. There's all sorts of sort of metrics you can dig into with what's the gross margins of the business, what's the overall sales cost, and there's a slide later that talks about the sort of alphabet soup of LTV versus CAC versus ARPU and all these sorts of things that you need to have an understanding on that's going to affect these valuations. But as far as what's the right valuation, it really is super independent on the companies. Companies, VCs like ours that invest in pre-seed and seed, we're happy. Certainly, if the company's in double digits, we start to, raise an eyebrow and really need to do some hard thinking. But we've absolutely done them because the company has very, very real traction, and in the grand scheme of things, it's still a great, great valuation in our opinion. Hopefully, good counsel, meaning legal team, everything else. The numbers are in good shape. You've actually taken the steps to create your business and the people around you helping you to create that business in a thoughtful way and are not being penny wise and pound foolish. Things like accountants, things like lawyers. Good lawyers, and if you're a good entrepreneur, you can find a good legal team that will take those fees on the come. So they'll be racking up bills, but you don't have to pay them until you close a round. Like, you should be able to do that if your opportunity is attractive enough and you are a good enough sort of business person, that is possible. So don't need to spend too much time on this. This stuff is sort of blocking and tackling, but just keep in mind that this stuff matters. Again, everything you do is indicative of your ability to what you're going to be doing in the future, right? So if you haven't done stuff in the past correctly, there's a presumption that the future may not look so very well either. Culture is super, super important. It's soft and it's hard to measure, so it rarely gets beyond platitudes of saying culture is important. But it's, cliches become cliches because they're true, usually. And it's super, super, super important. If you don't get the culture or done and properly sort of set up the way you want it early, it's not going to happen, because culture is exponentially more difficult to change than it is to create, and it is exponentially more difficult to have any ability to control the bigger the company gets. So that's something to contemplate very, very, very early. What are you about? What's the company about? What do you stand for? What do you not stand for? There's a well-known Netflix doc that you can find online about their culture, right? They go long into, look, we're not a family, we're a team, right? You don't fire your brother much as you want to, but you do fire a teammate if that's what needs to be done. And again, I'm not saying that's right or wrong, but the point is, you think about it, you be thoughtful about it, and don't hire someone who's not good with what you want your culture to be. First couple of hires are going to create that culture. There's no way around it. Also be a C Corp. If you want a venture-backed company, you got to be a C Corp, because they're going to want to invest in certain classes of stock that only C Corps get. Generally a Delaware company. Okay. Questions? Yeah. Oh, all right. Okay. Well, we've got to go fast. Market. You want a big market we talked about. You want a forward-thinking market that is willing to adopt new technologies. Competitors, you don't want a lot of them, and the ones that are there, you want them to be lazy and stupid. Customers and partners, again, proof points. If you've got customers and partners that want your product and service and want you to succeed, those are important not only because it tells you that the business is going to do well, but it tells you also that you as the entrepreneur is doing something right and have had interactions. You want those customers to be flush with cash. You want them to be price insensitive, willing to adopt new technologies, services, and they're rooting for you. Again, these don't exist, right? This is sort of the perfect thing that doesn't exist. I appreciate that, but these are the types of things that we're going to look for. And so you may have some weaknesses in one, but man, these customers are dying for this. Well, that's meaningful. Product service. You want the product to be unique. You want it to be defendable. If it's easy to rip off and copy, not too interesting. Talk about competitive moats. Those can be done in patents, trade secrets. Technically difficult if you've got some ability with some phenomenal engineers to do something that no one else can. That's wonderful. You want high margins. Software margins typically have 80 to 90% plus gross margins. Network effects, people familiar with those. Each additional user that comes on makes the product or service much more valuable. Think of something like Uber, eBay. More buyers want to be where the sellers are, sellers want to be where the buyers are. Viral, something's got a good viral quotient that attracts other users and customers very, very cheaply or free. It's a good thing. What's the need? Chewing gum, aspirin, or tourniquet. So it's an old VC sort of phrase where, what are you offering someone? Are you offering someone something that tastes good, but they don't really need it? You know, a game, something like that. Or as an aspirin, where it's really a need, you're solving a pain point, or the tourniquet, where you're saving their lives. So there can be very successful businesses in any one of those, but obviously if your customer needs it, really like truly to survive, that's a good thing. So cybersecurity, things like that, companies need it to survive, right? And it doesn't have to just be hardcore enterprise, right? Tinder, you could argue, is a tourniquet. It's a need. It's a human need for people to get relationships to, they're solving a very, very real need for human beings. So it doesn't have to just be, don't think security and things like that. Business model. You need to understand your business model very, very well. It's not easy. It usually takes iteration. Hopefully it's proven. You've gotten some proof points. You've proven that you can operate the business at scale in a profitable way. Ideally, you've got some sort of recurring revenue, right? If you are selling houses, well, people don't move that often, generally. That's, again, Zillow's a great company. It does very well, but that's one element. If you've got recurring revenue where you're charging people monthly, on a monthly basis, that's music to investors' ears. It's predictable. It's reliable. Is it sticky? Are people sticking around? Are there switching costs to your business or product or service once they've adopted it? Because acquiring users are hard. If they can just go on to the next thing very, very cheaply, that's less appealing than you've got sort of customer lock-in, where once they're on your platform, it's really difficult to get off. Organic growth, word of mouth. Investors don't like to pay for growth. If you're doing a bunch of Facebook advertising or Google AdWords in order to get your growth going, that's okay to start out, to get the word out a little bit, but it's generally not sustainable. And another thing that's very, very interesting, which is, I think, super important, more tactical, but what worked yesterday won't work today, right? So Google AdWords for a while was an inefficient market. You could do really, really well there. Facebook for a while was an inefficient market, right? Zynga, some other companies were literally created and successful on the back of Facebook. Well, Facebook got smart, the market got efficient, now it's not as affordable to do that. Similarly with Instagram, Twitter, Craigslist, right? So these markets get efficient pretty quickly. So as you sort of think about your growth hacks and how to build your business and your customer base, don't play old tapes. You learn from them, try them maybe, but realize that it's going to take something new. There's a new thing always out there that smart, we call them growth hackers, are able to leverage to get your business off the ground. Stage, this is pretty kind of a summary of what we talk about. Like for us, for early stage VCs, you want to have an MVP, familiar with MVP, minimal viable product, something that is actually built, showing that the product is in customers' hands, it fills their need, they like it, and there's strong product market fit. You understand that customer very well. They have, you've got proof points that they're using it, customers like it, the market likes it. Customers, large pipeline. We've got a company now that is stumbling a little bit on their technology, but their customer pipeline is incredible. They've got people literally calling, not daily, but weekly, saying, when is it going to be ready? When is it going to be ready? When is it going to be ready? And that metric alone is huge, because a lot of other things about the business not going so well. But man, if you got customers that want this thing, that's a huge thing. Like I said, business model, operating plan, very well understood. There's a whole lot that goes into it. The hiring, how you make money, how you're selling it, how you're marketing it, all those things are intertwined. Being able to understand that is super, super important, and being able to communicate that to the investor that you understand it is super important. Company with core team in place doesn't always happen or isn't always there earlier for the earlier companies, but generally the more and better core team you have in place, the better. I think that's pretty obvious. But it's also a data point. It's a signaling data point because it shows that very talented people with options want to work on your opportunity. So it's not just the fact that you've got a seat in the chair, it's that that person in that chair is very, very strong, or you've got other people, either you haven't hired them yet because you need funding, they want to work for you. Those sorts of things are important. Clear path to profitability. If you can't sort of have a fair amount of fidelity into how you're going to get from A or B or wherever you're at to the profitable, land, you gotta rethink it. And revenue growing quickly, obviously, that's pretty straightforward. Good news is all the stuff's available online. You don't need to listen to me drone on. There's some really great resources. Mark Suster, Feld, Steve Blank, Eric Reese, Sean Ellis. If you don't know those names, you should look them up. Generally speaking, the great venture bloggers, their earlier stuff is better because they say all the important stuff and then they sort of run out of stuff to say and then they just start talking about current affairs or whatever else, which is fine, but the blocking and tackling, the fundamentals of how to build your business generally is the earlier stuff. So I ran through the last half in about 5 minutes, but I wanted to make sure we got time for Q&A. I think that's it.
John, that was a fantastic presentation with so much detail. I mean, really, that was just like clear delineation of here's what we're looking for, here's what makes a potential partner a viable candidate, and ultimately what the restrictions are. And I think that's really important because as we're looking for money to fund our projects, aligning ourselves and making sure that what we're working on is in alignment with the venture capital, or maybe it's not a venture capitalist right now. Maybe it's something more along the lines of friends and family first to get your product to the marketplace, prove success, and then contact your local venture capital fund. We're going to open up to Q&A now. If you have a question, John is going to walk around with the mic. We're going to save comments and storytelling for offline. You'll be hanging out with us for a little bit. So if you'd like to pitch your idea, do it later. We're going to do questions now. Thanks.
So relative to, say, an angel group or angels, how big a stake and or control do you require in your investments in the company?
Do we require?
Or VCs in general, but you maybe personally?
Well, I think it differs a lot. I don't think it differs. I know it differs. So there's certain VCs that like to, they call it spray and pray. You just sort of write checks to anything that sounds good and then you just cross your fingers. Oh, that's not necessarily a bad way to do it. There's some phenomenal VCs that invest that way, so that's not a disparaging comment. It's just they take a broader stroke and they write checks looking for a lower percentage of equity, and they make more, they write smaller checks but more of them. And then there's funds like ours that tend to write fewer checks, like to get much more involved, try to add value. I mean, every VC says that. We try to do it, and hopefully we do. And we look for a more meaningful stake, a seat on the board, or at least a board observer seat. And so we make smaller bets, larger bets in fewer companies. I'm not dodging your question as far as what that equity, there's no magic equity number. It depends on the stage of those companies. Generally, what we like to do is to have a double-digit percentage when all is said and done. We will write, generally 3 checks over the life of the company. And it depends on the opportunity, how capital intensive the business is, how far along it is, whether we want to front load that equity, whether we want to back load it as the company grows and scales. It really, really depends. Happy to talk about some specific examples, but there's no sort of, at least I haven't found a reliable kind of rule of thumb there, unfortunately. But it's not the earlier stage, I mean, it's risk and reward, right? I mean, the earlier stage the company is, the cheaper it's going to be. And that's pretty straightforward, but other than that, I'm not sure there's any kind of, there's certainly industry metrics, right? In the Valley, the average seed stage company is going for, I don't know what it is, 23, right? In SoCal, it's, 8 pre or whatever. And so you can look up those with really broad strokes, but then you have to get more granular into a given industry and a given, stage, everything like that. So there's a lot of moving parts and variables.
Could you name some of the companies that have been like your rising stars, that your real success stories?
Sure. So, well, we've got 8 portfolio companies in our current fund. We're investing out of our 3rd fund, and there's, out of those 8 are rising stars. So we've got but I can talk about past exits. We've got a company called WellTalk that is doing phenomenal. We've got a company called CrowdStrike that's in the prior fund that's a unicorn, right? The fabled $1 billion plus company. Company called Connectifier, which was bought by LinkedIn, which was then bought by Microsoft, was a big win for us. Current portfolio companies, we've got a commerce SaaS business that's doing very, very well. It's enabling large e-commerce companies to manage their business better. It's called TrackStreet. We've got a company called Nimble, which is a consumer electronics company, which we just announced, which is very early, but they're doing really, really cool things. Consumer electronics is not something we traditionally do, but we know the founders very, very well, and they've got something really, really special. We've got an industrial 3D printing company that we're super excited about. I never thought I would invest in a 3D printing company for a lot of reasons, but again, this is a special opportunity that we're super excited about, and much earlier than we typically do. That was the teenage kid that we invested in that got high hopes for. I can go on and on. I mean, I don't think anything's going to really help edify, with whatever you're after, but you can go on our website, they're all there.
Second,
How much does it shrink the venture capital pool if you say you want to work in deep learning for medical cannabis?
Well, first of all, more specific is better. I think that's important to note, because if you're sort of broad, general, kind of appeal to no one, there are absolutely people that are looking for cannabis opportunities, and anytime it's product market fit, right? There are investors that are looking for that specifically, and you go after them. We do not do cannabis. Not that it's not a moral commentary on anything. We just feel like that's not a market that we sort of understand or can play in, and there's some overarching risks there that we just opted not to do. So I don't think it narrows the field for sure dramatically, but that's not a bad thing. If you're doing your homework, most of these funds that you're going after are going to have some narrow niches, and so you should be narrowing that field very broadly. Yes, there's companies like Sequoia and Excel and Kleiner that kind of do anything and everything under the sun, but for the earlier stages, most people have some industries or some ability to segment what they look for that's pretty granular, and that's a good thing. So it absolutely will narrow your market in a big way, but that's good.
Hey, right here. What advice would you have for a company that's, let's say, on the bubble between being venture-backed or not? And it seems like there's a danger if turns out you're not really meant for venture money, but you raise venture money. So I guess what advice would you have in terms of thinking that through?
So there's no perfect answer, and the details matter. Yeah. So what I'm about to say may be very different given your specific sort of message. But generally, and look, there's a few ways to look at it. As a founder, you should want to keep all your equity, right? If you can bootstrap a company and that company can become a $1 billion company, do that, right? Don't take venture capital, unless it's right to do so. And when it's right to do so, it's when you think you really can get value by what they bring besides money. And of course, if your business needs a fair amount of capital to scale, you're going to need to get some outside money, and so that's fine, it's appropriate. But if you are on the bubble, as you said, I would not unless you already have offers coming in, I would probably wait. Always wait, get more traction for a couple reasons. A, you don't want to get in that situation where you've raised some money and you haven't delivered. But B, when you're going out looking for money, if you're not really fundable yet, it's a small community, word gets out, there's this sort of term called deal mold, where it's like, yeah, I saw that thing before, I'm not, passed once, it's really hard to re-engage, even if your numbers are very different, Again, there's exceptions, it does happen and all that, but generally speaking, if you can afford to wait, I would wait. If you feel like you can't get there without funding, then sure, you don't have much choice, right? But if you have a choice, I would wait.
Can you provide some insight on getting that first meeting? Like, what is a good first impression? I'm sure you see thousands of pitch decks in a month or a year. Like, what actually stands out and grabs your attention to accept a meeting?
Yeah, actually, a lot's been written on that, and that, back to the resources I was talking about. I mean, Suster has a whole thing on this, and so my opinion is that it's just like human nature, right? How do you do anything? You figure out a hook to get in front of them. I have had people that just email me directly, generically on LinkedIn, whatever, and if the thing is compelling, we'll take a look. Some people have straight across the board, unless it comes from a warm intro, I won't do it. Because A, I've got too much, it's a filter, it's not perfect, and I'm sure I'm missing out on some opportunities, but if someone I know and respect is willing to make an intro, that says a lot about this potential opportunity, and it really cuts through the noise. That's not the way I operate, because I've sort of been there having to do cold emails and all that stuff, and but it's reasonable. So everyone's a little bit different, but generally warm intro is always the best. If you could do that, absolutely. If you can have a hook, I've had people FedEx me plans, which is sort of, isn't done a whole lot nowadays, and I'm going to open it. I'm not going to not see what's in the FedEx. So there's little hooks and hacks and kind of cheesy things you can do, but they're effective. And again, all of these things are data points, right? If you figure out a really interesting way to get to me, that says something about your hustle, your ability to sort of do a lot, do a little, and kind of navigate. So those things are meaningful. I don't have a silver bullet. The best way, certainly the best way for sure, is an intro, a warm intro to somebody that we already know. Second best is traction. You send an email with it, shows this is my business, this is the market, this is the, we're profitable, we're already on a $2 million annual run rate, we've only invested, $50,000 in the business. I'm not saying that's possible, but that's going to get someone's attention, right? So there's a lot of ways.
So at the end of the day, regardless of all metrics, it's essentially a gut decision whether you're going to invest or not in many ways. And you're mentioning this 19-year-old boy, which I have a visual image of based on the 19-year-old boys in the Valley and everywhere else that get invested. So I'm curious what you're doing to actively measure the metrics of who you meet versus who you invest in to avoid pattern matching.
Sure. So I wouldn't say that's exactly true. Absolutely, gut matters. I'm a believer in that. People say that people make a decision on emotion and then justify it with data, right? So there is some of that. It's human nature. You can't get around it. But we're definitely and most VC, any good VC is definitely metric driven. They're going to look at these numbers. And so, the 19-year-old kid just you mentioned, that was compelling because he was able to paint this pictures with a ton of data, with a ton of metrics. He had solid proof points. The guy already had some patents that were already applied for. So there was a lot of very concrete, objective, not subjective metrics that we were able to analyze, get comfortable with. The market size, how we can disrupt it if we can meet a certain price point, what that means. And so it's not, wow, this guy or girl is really.
Yeah, but would a 50-year-old black woman with those exact
absolutely,
metrics have
absolutely,
the same investment?
Absolutely. I wanted to fund. I couldn't get my partners over the line. Long story, but there was I don't know where she's supposed to get. You're not allowed to ask that, or I wouldn't ask that. But she was, she fit that bill, phenomenal. Selling into the government space, knew her audience really, really well, had some really early traction. I was all over it. She's actually gotten funded, by other VCs. So I think it's less about that. I think a bigger problem, and absolutely a more real problem, is the sort of network of who you're hanging out with. The typical VC may not be interacting all that much with the type of person you just mentioned, as opposed to somebody who went to Stanford, computer science major, everything like that. That's just kind of who they're rubbing elbows with. That's a huge problem, absolutely. But I think that once you sort of get in front of an investor, I'd like to think, the good ones at least, that matters. I don't think all that much. In fact, some ways, and I can tell you very, very, as a matter of fact, that there are plenty of funds that are looking only for those types of opportunities for a bunch of reasons that you can probably imagine a lot of them. So I'm not going to pretend that it's always easy for certain groups, but it's absolutely, there's money out there.
But you're not tracking it internally in your...
One more question over here.
Meaning, do we have sort of goals or benchmarks that we're trying to hit as far as the types of founders we're trying to hire or trying to fund?
Are you just tracking who's getting investments and who's not?
I'm sorry, but can we get one more question over here?
Sure. We are tracking it. We're tracking a lot. I mean, do we have certain checkboxes for certain things? We're a small firm with 3 partners, so.
Hey John, great talk today. A question: if an entrepreneur comes into your office or you take a meeting, it's a product that's maybe innovative in an emerging market, not a lot of data points. How would you like to see them kind of articulate the financial opportunity, revenue forecasts, given the lack of data? It looks like a compelling way to do that.
So financial models are interesting, and there's one thing we know about them is that they're going to be wrong. I mean, nobody ever hits it. You can't predict the future. It's more about the thought process and how thoughtful you are about kind of viewing this. Do you understand your customer that well? What is their willingness to pay? What is their ability to pay? How are they used to paying? It's a matter of how thoughtful you are. And look, things are going to change, right? It's plans are useless, but planning is essential, right? You have to go through the exercise knowing that the minute you start to go out and interact with the customer, you're going to learn a ton, and things can change totally, very, very dramatically. That's okay, and we know that, especially the earlier side. Just be very, very thoughtful about it and thorough, and acknowledge that you don't have all the answers, right? That's what you're looking for funding for, is to interact and build and learn.